Hey, Wilf, it's a beat on the top and bottom lines. Lyft lowering its cash burn. Now, the stock did pop nearly 6% right after those results, but it just went into negative territory. Now it's kind of flat just above the break-even line. It raised its full-year revenue guidance and giving an improved EBITDA loss outlook. However, the stock may be sort of bouncing around because it has gained quite a bit on the back of comments from last week that it would be EBITDA profitable earlier than expected. Now, here's what we know from the quarter. Third quarter revenue coming in at $956 million versus $915 expected. Loss of $1.57. That's better than the $1.66 Wall Street forecast. Active riders and revenue per active riders also slight beats there. Just last week, as I mentioned, the company said that it would reach EBITDA profitability earlier than expected by the end of 2021. The question now is, though, how does it get there, especially when net loss this quarter alone was more than $460 million? I asked that question to Lyft CFO Brian Roberts. He said they'll get there through focus. He said, we're not doing food, we're not doing trucking. We are 100% focused on our transportation network and platform scale to unlock more efficiency. Now, Uber, of course, its larger ride-sharing rival, is in those areas, many more, and has not given investors a detailed timeline to profitability. So again, like we've seen in past quarters, Lyft upping the pressure on its larger rival as it gets ready to set to report on Monday. Back to you guys.
Here's the problem with that, though. If that's true, so first of all, I feel bad for the guy. When he came public, nobody wanted profits. They wanted growth as far as the eye can see. And then the story changed for the Valley, so now he has to change his whole focus on the fly. That's fine. If what he says is true, why would a publicly traded taxi and limousine service have a $12 billion enterprise value? Does anyone think this is a good business? So if they're not going to platform this thing and be a quote-unquote tech company and get into other areas, they're going to focus on making taxi rides profitable? Sold to you.
Lizanne, I want to get final thoughts, final word from you. I mean, if you had to thread the needle between all of the earnings results you've gotten so far, these are all consumer-facing companies. What does it tell us about, I guess, where we're at in earnings and what the read-through for the economy, and also just the fact that we've closed at record highs for the S&P?
So I think the record highs for the S&P probably reflects Fed policy as much as anything else. The one thing I'd be mindful of is that if you look over the past almost 2 years in what had been a pretty wide trading range for the S&P until the recent breakout, sort of extremes of investor sentiment really marked some of those interim peaks and troughs. So I'd pay close attention to the sentiment metrics. I think, specific to earnings and the consumer, a lot of what the Fed said today in the statement reflecting the beleaguered manufacturing sector and weak business investment versus a stronger consumer, that I think is key to watch from a macro perspective, whether we maintain that fairly healthy dividing line between the industrial side of the economy and the consumer side of the economy. We started to see some cracks through the employment channels. I think that's key to focus on to see whether that morphing into some weakness in services on the consumer side through employment continues. We only really had one negative month of data through things like ISM employment, but I think the next month or two will give us greater color on whether we can maintain that healthy dividing line.